Hey everybody, welcome back. I'm Maya, here with my good friend Vid. I saw the headline about the Fed staying hawkish and thought, what does that have to do with my money?
Haha, great question, Maya. Picture this. The Fed is the thermostat for the whole economy. When it keeps the temperature high, meaning interest rates stay up, it changes how people think about buying stocks, especially those that pay you cash every quarter, called dividends.
Dividends, that's the word that keeps popping up. But what exactly is a dividend?
Right? A dividend is simply a slice of a company's profit that they hand out to shareholders, kind of like how a landlord hands out rent checks to tenants each month. If you own a share, you get a piece of that profit.
So it's like getting rent from a stock. That sounds nice. How does the company decide how much rent to pay?
Exactly. Companies set a dividend per share, often quarterly. For example, imagine a big utility like Duke Energy declares $0.90 per share every 3 months. If you own 100 shares, you'd collect $90 each quarter, or $360 a year.
Wait, so I'd get $360 even if the stock price never moves.
Yep, that's the idea. It's called the dividend yield, which is the annual dividend divided by the current stock price. If Duke stock trades at $60, $360 divided by $6,000 total investment equals a 6% yield, like earning 6% interest on a savings account, but you also own the company.
That's a lot clearer. But why do companies pay dividends at all? Why not just keep the money?
Great point. Think of it like a bakery that makes extra loaves. Instead of letting them sit, the owner shares the surplus with the staff. Companies pay dividends to reward investors, signal confidence, and attract a certain type of investor who likes steady cash.
Okay, but how does all this tie into today's market vibe? The VIX is at 17.11, oil at $75.81, and the Fed's still hawkish.
Right, so the VIX, a measure of market fear, is relatively low at 17, meaning investors aren't jittery. Oil at $75 is modest, keeping corporate costs steady. The Fed's target range of 3.5–3.75% signals borrowing stays pricey, which makes high-yield dividend stocks attractive because they offer cash without needing a loan.
I get that. So investors might chase dividend payers when borrowing costs are high.
Exactly. Imagine you're deciding between renting an apartment, paying interest on a loan, versus getting a room where the landlord also gives you a monthly stipend. The stipend, like a dividend, helps offset the rent. When rates are high, that stipend looks sweeter.
Got it. But I'm still a bit fuzzy on how dividends actually get paid. Do they just appear in my bank account?
Good question. When the company declares a dividend, they set a record date. Think of it as a snapshot. If you own the stock on that day, the company sends the cash to your brokerage, and then the brokerage deposits it into your account. It's like getting a paycheck after a work week.
So there's a timeline: declaration, record date, payment date.
Yep, 3 steps. Declaration is the announcement, record date is the cutoff, and payment date is when the cash lands. Most companies do this quarterly, roughly every 3 months.
And what if the stock price drops after the dividend is paid? Does that affect what I earned?
That's the ex-dividend effect. On the day a stock goes ex-dividend, meaning you no longer get the upcoming payout, the price typically drops by roughly the dividend amount. It's like the company handing you cash, so the share's value adjusts downward. But you still keep the cash you received.
Okay, so the net effect is neutral.
In theory, yes. You lose a little on the share price but gain the cash. In practice, market forces can make the price move more or less, but the dividend still adds to your total return.
Speaking of total return, how do dividends stack up against just price appreciation?
Picture 2 friends. One buys a growth stock that climbs 10% a year but pays no dividend. The other buys a dividend stock that climbs 4% and yields 5%. After a year, both have roughly 910% total return. Dividends can be a big part of the puzzle, especially when markets are flat.
That makes sense. So with today's news, Bank of England holding rates, Fed staying hawkish, what does that mean for dividend investors right now?
Okay, picture a coffee shop that keeps its coffee prices steady while other cafes raise theirs. Customers stick with the stable shop. Similarly, dividend stocks with reliable payouts become a safe harbor when interest rates stay high and inflation worries linger. The neutral market regime suggests we won't see wild swings, so steady cash flow looks appealing.
Interesting. Are there any sectors that are especially good for dividends right now?
Definitely. Utilities, consumer staples, and telecoms often have high yields because they generate consistent cash. For example, AT&T trades around $14 with a quarterly dividend of $0.53, yielding about 5.5%. That's a classic income play.
But aren't those companies sometimes risky? I mean, what if they cut the dividend?
Good point. Dividend cuts happen when profit drops or cash needs shift. Think of a friend who promises to pay you $50 each month for chores, but then loses his job. He might have to lower the payment. That's why you look at the payout ratio, how much of earnings they pay out. A ratio under 60% is usually a safety cushion.
Payout ratio, another new term. Can you break it down?
Sure thing. Payout ratio equals dividend per share divided by earnings per share. If a company earns $5 per share and pays $2 in dividend, the ratio is 40%. It tells you how much of the profit is being handed out. Lower ratios mean more room to keep paying even if earnings dip.
Got it. So a lower ratio is like a bigger emergency fund.
Exactly, a financial safety net.
Let's bring it back to today's macro. With the 10-year Treasury at 4.45% and the Fed not cutting soon, does that make dividend stocks more or less attractive?
Imagine you have two buckets. One is a Treasury bond yielding 4.45%, the other is a dividend stock yielding 5% but with price risk. If you're comfortable with a bit of risk, the dividend bucket looks juicier because you get higher cash flow plus any price appreciation. If you're ultra cautious, the bond wins. Right now, the modest VIX suggests investors aren't super scared, so many tilt toward the dividend bucket for that extra yield.
So it's a balance of risk and reward. If I'm just starting, which approach would you suggest?
Think of it like building a pizza. You want a sturdy crust, core holdings like index funds, a tasty sauce, steady dividend stocks, and a few spicy toppings, growth picks. For beginners, start with a broad index like the S&P 500, which already includes dividend payers, then maybe add a high-yield utility or consumer staple for extra cash flow.
Okay, I love pizza analog.